Good evening, traders and investors. Will back here with another one, coming to you with a Thursday market recap. Hopefully you are all doing very well today, and that you wrapped up a very good week of trading in the markets, as tomorrow is closed in observance of Good Friday. Happy early Easter to each and every one of you out there that observe the holiday, of course. Now, moving into the markets, guys, the index is today largely ending flat. We did have a few key names that moved big to the upside and to the downside, which we'll take a look at later on in the video. But overall, today was a fairly boring day in terms of news headlines, no real big macroeconomic events, and no updates on tariffs either. However, we did have one piece of news come in, which is eerily a reflection of 2018 as well, which was Trump once again calling to fire Jerome Powell. I'll remind you guys that Trump doesn't have the power to fire Jerome Powell, only for cause, and so far there is no actual cause. Jerome Powell's term would end in May of 2026, but that was a news headline that sent the markets into a little bit of a dip into the late stages of the afternoon, but overall the market's largely ending flat. So in today's video, guys, we're going to cover a few key things together. Number one, we have a few earnings to cover together, and those are going to be quite simply TSMC, UNH, which had one of its largest moves since 1998 to the downside, unfortunately, and Netflix. Special shout out to American Express. We'll be reviewing them on Monday. Their earnings were actually quite good, but we're going to keep it to about 3 earnings for today's video. So I'm going to choose these ones for now and do AXP on the Monday session. So we're going to cover those earnings first in the video. Thereafter, do a full technical analysis rundown of our major market indexes. Check on that rotation because some sectors definitely did better than others today. And thereafter, guys, go through our big tech name list and see which of the big tech names are still in buy the dip territory and which ones should we possibly avoid or be more patient on. Lastly, we will wrap it up with a quick glimpse into my portfolio for the trades that we concluded today and several of the positions that I'm keeping into next week. So it should be a very fun video, guys. Let's jump right into it, shall we? So the SPY up 0.14%, the Q's largely flat. Taking a look at the heat map here, you will see that, well, once again, guys, big tech just not able to keep it up right now, other than Apple performing very well. Semiconductors still weak. Microsoft, Amazon, Google, Meta, and Tesla just not performing too well at all. But the rotation to the bottom half of the market, defensives namely, was doing very good. The banks coming back today as well. Healthcare was a mixed bag. Eli Lilly having a 14% day after their trials for their new version of the GLP-1 obesity drug, right? The weight loss drug, essentially, which is also used for diabetes, performed quite well. Conversely, a stock like NVO, their main competitor, was down over 7% on the day as a result of that news. So Eli Lilly really benefiting from that news piece this morning. And of course, UNH, whose earnings we will cover. But overall, very decent day of rotation across the markets, depending on which stocks you were invested in. On the one-day relative, guys, you'll see that even better to where most of the market was up. However, healthcare, because of UNH, got dragged down into the mud, and technology just because of the growth concerns continuously surrounding big tech and especially semiconductors. Even TSM's earnings that we'll cover soon was not enough to save those markets. Now, before we get into more technical analysis, as a matter of fact, let's cover some of those earnings. And we're going to start off with the biggest one, the biggest mover of the day, which was UNH. So UNH, fantastic company, guys, the largest healthcare insurance provider in all of the continental United States. And it's not even close. They had their worst day since 1998, where they dropped 28%. Today, they were down 22%, coming into daily oversold RSI conditions, a very attractive level of support. But what exactly happened? Well, it all starts with this right here. They had their first earnings miss. Look at the red right here. Their first earnings miss, guys, in like 5+ years. They missed on EPS and also they missed on revenue. A very rare miss for UNH. But this is not so much a byproduct of what happened today. This had been building in UNH, and we covered their quarterly earnings every quarter, or at least we have for the past 4, 5, 6 quarters in a row. And we knew that something was brewing, and it all had to do with the Medicare and Medicaid allowances, right? I'll remind you how these companies operate, these health insurance providers. The government is going to give them a certain allocation of money, which then they can use to offset some of the costs for patient insurance claims. That is under the Medicare and Medicaid programs, respectively. Now, the problem arises when you have, as a result of insurance, rising medical costs, but the amount of the money that the government is giving you is either stable or, from the Biden allowances previously established in 2022, they are actually cutting cutting subsidies to these companies. So when you have rising medical costs and then the government is squeezing you to the downside, it erodes your profits. And one of the major reasons for the drop today was a reduction in the EPS guidance, aka profits for the company for the entire year. It's an extremely solid stock, guys, but eventually these headwinds have caught up with this company. However, there is some solace on the horizon, and we're going to get into that as well. This problem is currently being fixed. We actually got some news to that effect just a few short weeks ago up here. So let's move into the article, shall we? So, United Health sees a surprise jump in seniors getting treatment, and the stock suffers the biggest drop in decades. Since 1998, shares of UNH took a historic plunge Thursday after the health insurer slashed its full-year outlook and missed quarterly earnings expectations for the first time in years, citing increased care activity in its Medicare Advantage business. Basically, a lot more seniors sought treatment than previously expected. The company started seeing the problem as the quarter closed in March, with increases being most notable in physician and outpatient services. The CEO said on the post-earnings call with analysts that the company had been planning for 2025 care activity to increase at a similar rate as 2024. This was a problem they had in 2024 as well. They have obviously guidance in terms of how much active care are patients possibly going to require, how many premium claims are going to be filed. However, it blew past their expectations. Instead, though, first quarter 2025 indications suggest care activity increased at twice that rate, right? So when you're paying out a lot of premiums and you're getting squeezed by those government subsidies to the downside, it erodes your profit margins. So moving on further, UNH said it now expects 2025 adjusted EPS in a range of 26 to 26.5. Down from the previous guidance range of $29.50 to $30. That is an over 10% miss on EPS guidance, the profits getting squeezed for the reasons that I previously explained. That means yearly EPS is headed for its first decline since 2008 during the Great Financial Crisis. This is true, guys. UNH is a legacy company. They're normally a very consistent company as well. As you can see from this forecast tab, EPS probably always goes up and to the right, except for 2025. We will be having a ever so rare dip in EPS. Revenue, however, will continue to be maintained. It's just their profit margins that are getting squeezed right now. Now, moving on further, adjusted EPS rose this quarter to $7.20 from a year ago, but also missed the consensus of $7.29. So double miss on guidance and miss on this quarter as well. It was the first quarterly EPS miss in at least 5 years. The medical care ratio for the quarter, or the percentage of premium dollars spent on services, lower is better, right? Increased to 84.8% from 84.3% due to the ongoing Medicare funding reductions and higher senior care activity. Now, this was addressed previously, guys, a few weeks ago, to where the health insurance board essentially was able to increase now the allowances provided to these companies. This news is just a few weeks old. As a matter of fact, April 7th, it came out, and you'll see here that they were expecting a 2.23% subsidy, and now that has been increased over double to 5.06%, but that change only comes into place for 2026, which is why I still think this stock is a tremendous buying opportunity right now in relation to those revised numbers to the upside for next year moving forward. So moving forward now in the article, total revenue for the quarter grew by 9.8%, but it also missed the consensus by roughly $2 billion. UNH revenue increased 12.3% to 84.6 billion as well. The total number of people served was up to 50.13 from 49.18, so they continuously grow their customer base as total community and senior people served rose from 20.13 from 19.77. So doing a good job, guys, of just consolidating their mini empire that they've built. They have a sheer dominance over the health insurance landscape. And the insurance providers, guys, are some of the most resilient companies in all of healthcare. Optum revenue, their other line of business, they have, a pharmacy, a health, it's like a telehealth service, but also a pharmaceutical business as well, was up 4.6% as well. The pharmaceutical business jumped 13.9%, but the Optum Health, the telehealth services like Teladoc, fell 5.3%. I mean, Optum Health is a lot more than that. It's like a wholly encompassing passport, an online passport for all your claims and stuff like that, right? Very nice service that they have. Now, the CEO provided some hope for investors as they look past 2025 and into 2026. the new Medicare Advantage payment rates, which I just showed you in the article right here, have been notably higher. So the CEO was very bullish on that in terms of, that the government will start reflecting the accelerating costs seen for years and help undo the price cutting implemented by the Biden administration. So that is everything we had to see for UNH, guys. Tremendously strong company. Sure, they had their headwinds. The headwinds have now caught up with them. We have priced in most of all the damage for the entire year. This company really doesn't go through any major changes from quarter to quarter. It just operates a very smooth and consistent and predictable business model. But now with those Medicare Advantage rates being renegotiated for 2026, I think this could possibly be a tremendous buying opportunity for this company. Not only maybe for a short-term swing trade out of the support range down here, right, the whole 486 down to 449 area, but if we've been patiently waiting for an opportunity to put UNH in our long-term portfolios, because the long-term charts looks like this, right? Just very consistent, very profitable company overall. Not a bad idea. And here is why. The valuation is also quite attractive right now at 455. They're trading at a forward price to earnings. This is with a reduced EPS number of 17.33. That is very cheap. The historical average is a 21, a 1.24 forward peg ratio, a 0.92 price to sales, and a 4.5% free cash flow yield. Fantastic company, very decent valuations, and I did take a trade on this one myself today. Full disclaimer, it's not in my long-term portfolio. I usually don't have health companies in my long-term portfolio, but if you do want some healthcare exposure, I mean, this is one of the biggest and the best companies and most consistent companies in the entire healthcare landscape overall, and it's at a very attractive valuation currently at the moment. So that's everything we had for UNH. Now let's get into some tech stocks, shall we? So the first one we'll be doing is TSM, the semiconductor plays that unfortunately have all been significantly down over the past 6 months. For the most part, you can take a look at that. The semiconductor index as a whole has not hit new all-time highs, guys, since last July. It's almost coming up on an entire year, about 9-10 months worth of downside or sideways choppy action for semiconductors as the AI narrative continuously comes under question. And as well, they're fighting with a lot of tariff narratives right now. However, as we saw last Friday when they posted their sales numbers, they absolutely crushed this quarter. However, today we're only up 0.10%. You'll see these numbers, they were absolutely amazing. For a company like this to be trading at such a cheap valuation and to be only up a fraction of a percent after these phenomenal earnings might give us an indication as to what we can possibly expect from other semiconductor companies this season. We just got Micron a few weeks ago. Micron, after this earnings, we covered it on the channel, guys. They increased their guidance. They literally increased their guidance and crushed their earnings. And yet still the stock is down 30% from that point. TSMC absolutely crushed their quarterly earnings and the stock is roughly flat. They were up about 2%, 3%, but gave it all back. Let's take a look at some of the numbers, shall we? EPS beat by 3.5% and the revenue beat by 1.35% as well. Let's take a look at the article, shall we? TSMC sticks with its revenue forecast after profit tops the estimates, and that is despite the Trump trade worries and the tariffs. Let's move into it. TSMC's net income increased 60.3% from a year ago. Fantastic profit margins from the company, guys. Profit margins are standing currently at about 43%, which is just ridiculous for a product company. Those are like software company margins. Now, the high-performance computing division, which encompasses AI and 5G applications, drove sales in the quarter, increasing 7% since the last quarter and accounting for 59% of total revenue. The advanced technologies division, defined as the 7nm and less, accounted for 73% of total wafer revenue. In semiconductor technology, smaller nanometer sizes signify more compact transistor designs, which lead to greater processing power and efficiency. TSMC are the absolute kings of doing this, guys. They really have the leading technology and they have the smallest chips, the most efficient chips overall. You can see that revenue breakdown here from the 7nm, which is in blue, which is being phased out, to the 5s, which also is slowly being phased out in favor of the new 3nm chips. Very, very good technology by this company. Moving on further, business in the fourth quarter was impacted by smartphone seasonality. We've been hearing that for the last year, and personal electronics as well, but partially offset by continued growth in AI-related demand. Here's what the CEO had to say. CC Wei, moving on to the second quarter of 2025, we expect our business to be supported by strong growth of our 3nm and 5nm technologies. On the tariff front, Taiwan currently faces a blanket 10% levy from the Trump admin that could rise to 32% if the 90-day pause of the reciprocal tariffs ends unless it reaches a deal with the US. So that is a looming threat to the company right now. We understand there are uncertainties and risks from the potential impact of tariff policies, said the CEO, noting, however, that the company has yet to see any changes in customer behavior. More specifically for AI, the narrative is still strong. As I've been saying for the last few weeks in semiconductors, guys, the AI narrative, as displayed by the kings of the game right now, whether it's Micron with their HBM, right? High bandwidth memory and their DRAM, whether it's TSM right here, whether it's ASML earnings that we just saw yesterday. The AI narrative is very strong, but it is being buried under the narratives of tariffs right now, right? Now, moving on further. Therefore, TSMC has maintained its forecast of close to mid 20% revenue growth in 2025 amidst continued AI development. In an apparent response to Trump's trade policy, TSM last month announced plans to invest an additional $100 billion in the US on top of the $65 billion it had committed to 3 plants in the US prior. However, on the earnings call, Wei dispelled reports that the company is in discussions about entering a joint venture that would operate factories of US chipmaker Intel. This was a rumor that was circulating roughly a month ago, where basically TSMC was going to hold Intel's hand and show them how to make chips properly. Unfortunately, a rumor was just a rumor. The CEO of TSMC dispelling those rumors right away. On Monday, AMD said it would soon manufacture its chips at one of the new Arizona-based TSM facilities. That's the first time they'll be doing that in the US. And the same day, NVIDIA also announced starting production and testing of the Blackwell chips at TSMC's Arizona plants as well. Now, moving on to the valuation of the company, guys, we can cover a few things in these earnings slides. There's nothing more to see. I just wanted to show you guys the breakdown here of the nanometer by revenue and how they phase out older models for newer models. Makes perfect sense, right? Here's the first quarter of 2025 revenue by platform. So you can see that the HPC, right, is the AI trade, in other words, right? The high-powered computing division, 59% of total revenue. Smartphones, 28%. But the smartphones, guys, it's just a cyclical business right now. We've been hearing that from Apple. We've been hearing that from other players. Just people are not, buying new electronic devices right now. Well, they are, but not at the same rates that they were in 2021 and 2022. It's a very cyclical market, right? The market of personal electronics for consumers. Now, moving on further, you can see that smartphone and IoT, Internet of Things, were the only two divisions that were down, but the data center applications and AI applications were up. Automotive was up as well, and a few other segments too. So TSMC overall, guys, high quality company, right? It is a semiconductor business, but I want to focus on this right here. 43% Q1 net margins. That is absolutely ridiculous. Revenue guidance was reiterated. The AI chip demand is still extremely high. It's a very high profitable business, guys. Talking about 43% net margins, that is absolutely crazy, which gives them a very juicy amount of free cash flow per year that they've been steadily increasing in the last few years. And this quarter is no different. In terms of their EPS expectations, you can see that although it's a semiconductor company, it's more consistent than a lot of companies out there. Pull forward of demand in 2022, and then we had a bit of a cyclical lull, but now we should be going back to expansion over the next 3 years, which is why I like this company as part of a long-term portfolio. Revenue as well will be moving a lot higher over the next 3 years as the AI trade remains strong. As per valuation right now at 152, I've been basically calling this one out on the channel for each and every one of the last 3-4 weeks at this point. It's very cheap. At 152, forward price to earnings is a 16.7. That is extremely cheap, guys. The PEG ratio is now under 1. I'll remind you, anything under 1 is very good. Between 1 and 2 is okay. Above 2 starts to get very expensive, and the free cash flow yield is sitting at 3.3%. I have nothing to criticize of this company other than a few notions which are largely sentiment-based. Well, they're real-based, but right now it's been dragged down by sentiment. Number one, of course, is the looming threat of tariffs and how it can impact trade, especially towards China and trade between China and the US, and how it might hinder the growth of the overall market, at least in the short term, as people are kind of nervous and timid about putting in large orders if they don't know where they can ship their final products, right? Or at what cost. Number two, of course, is the geopolitical risk of the perpetual, notion of China potentially invading Taiwan and nationalizing Taiwan overall. That is the reason that Warren Buffett pulled out of this stock about 3 years ago at this point, because he had invested a heavy sum of money in the company because even he could see the long-term growth prospects for it, but eventually got cold feet and stepped away due to that geopolitical risk. If you are able to assume both of those risks, I think this business is a fantastic company. And even for some swing trades, I've been a very big fan of selling some put options down here, guys, in the lower 140 to 130 levels, which is coming into 2021 highs with much better fundamentals at this current time. The company is still down from the tops about 33%, but if we get filled down there, guys, it'll be almost 40% off the highs. Fantastic company, in my opinion, for a long-term portfolio, despite the risks, and also a very nice company to possibly swing trade if we move back into some form of daily oversold conditions and culminate into a very large area of weekly support and the weekly 200 EMA, which currently sits around the $135, $130 mark. That's everything for TSMC. Now let's get into the juicy one, the juiciest one of them all. Well, it should have been juicy, but Netflix today only up 1.19%, and they literally just closed the after hours, guys. So I'll have to show you this after hours price action. You will see that Netflix was up a decent amount in the after hours, 4.83 to the top, but ending only 3.5%. They posted amazing numbers, guys. Everybody was expecting that. Maybe that's part of the problem. Maybe the part of the problem as well is that they're up so much year to date when the markets are down, right? This company is currently up 8.6, now almost 11% year to date with the after hours move, and the SPY is down 13%. So maybe that outperformance and maybe just the back-to-back record quarters are catching up with them in terms of the market not wanting to buy at these higher levels at these somewhat extended valuations in the midst of a market correction. Perfectly normal, but if this is any indication, right? TSMC, fantastic earnings, right? And still, they did nothing. Netflix, amazing earnings, and are right now only up 3.5%. It might give you a little view into what we could expect this entire earnings season. Even the banks, guys, the banks were up very nicely after their earnings. They gave it all back, right? JP Morgan was up nicely after their earnings, gave it all back. Wells Fargo was up nicely after their earnings. They're pushing a little bit higher, but still nothing fancy. Bank of America was up good after their earnings, but then pretty much gave it all back too. Even American Express will cover their earnings on Monday. They had very good earnings, guys. No real problems with their consumers, and yet they were down today. So it's just to show you, right? Tough crowd in this market landscape right now. However, I digress. Let's get into their numbers, shall we? So Netflix right now, beating on EPS. This is crazy beat, guys. 16.5%, almost $1 beat on EPS. That is a massive beat and a 0.39% beat on revenue as well. Overall, guys, a very good quarter for them. Let's jump right into the article. So Netflix posts major earnings beat as revenue grows 13% in the first quarter. Let's start reading, shall we? The streamer attributed its better than expected revenue to higher than forecast subscription and advertising dollars, really milking the heck out of that lower cost advertising tier. In late January, they increased pricing across the board, raising the standard plan to $17.99 a month from $15, the ad-supported plan to $7.99 from $5.99, and its premium plan to $24.99 from about $20. So, company has pricing power and did not see many cancellations. If anything, they increased their subscriber count. They did not give an exact number for subscribers. They just said it went up. The company is now stopping to report those metrics, possibly because they're hitting that wall, right? They've accumulated all the customers that they can, and they don't want Wall Street to focus too much on that subscriber count number. Kind of the same problem that Meta has every single one of its earnings releases, but now they want to shift focus onto the profitability metrics instead. Talking about those, they said that they continue to forecast full year revenue of between 43.5 and 44.5 billion. So no change on the yearly guidance. So very strong. And here's what they had to say about the current macro environment. There's been no material change to our overall business outlook, the company said. As investors worry about the potential impact of tariffs on consumer spending and confidence, Netflix co-CEO Greg Peters said on the company's earnings call, based on what we are seeing by actually operating the business right now, there's nothing really significant to note. Yeah, That's the highlight of the earnings call, guys, that they're not really seeing anything. Now, and he goes on to say entertainment has been pretty resilient overall as a business, but Netflix specifically also has been generally quite resistant. They have not seen any major impacts so far. So very nice beat on EPS. Net income for the period was 2.89, guys. 27.4% net margins. That is the best net margins of Netflix ever. So really milking that advertising tier, guys, and just increasing profitability overall. Netflix has been leaning on advertising as it seeks to soften slowing subscriber growth. A key focus in 2025 is enhancing our capabilities for advertisers. The company launched its in-house ad tech platform in early April in the US, with plans to extend into other markets in the coming months. By the way, this was one big loss as a client to another advertising wholesaler, which is Trade Desk, the Trade Desk. We believe that our ad tech platform is foundational to our long-term ads strategy, the company said, and over time, it will enable us to offer better measurement, enhanced targeting, innovative ad formats, and expanded programmatic capabilities. So there you have it, the earnings for Netflix, guys. In terms of their earnings slides, I mean, there's nothing really much to report. It was somewhat of a boring earnings report from Netflix, which is exactly what you want to see. Now, of course, as per usual, they go into several highlights of different shows that did well for them and ongoing programming ventures such as, 52 weeks of WWE and continuing to build upon their live streaming sporting events, which will do very well for the company. But other than that, no major announcements at all. But take a look at this Q2 2025 guidance, the upcoming quarter. Look at this increase in operating margin, guys. This quarter, 31.7, 33.4, 33.3 in the next quarter overall, which will give them a net income margin of 27.6%. That will once again be record-beating net margins overall. In terms of free cash flow, they brought in another $2.6 billion of free cash flow and slightly reduced their share count in the process, which really helps to increase that EPS structure overall through time. Now, a few key highlights that we're really going to point out here, right, is that in their revenue forecast, which was maintained, they assume healthy member growth, although not saying how much, higher subscription pricing, and a rough doubling of our ad revenue. This is the key point right here. A rough doubling of the ad revenue. Now, here is a bunch of different things in which they say they had different success rates for, different shows and stuff like that. But we're just going to look at the competition here. We have a huge audience that's estimated to be more than 700 million people, which is insane. They continue their international expansion, while the majority of our content spend and production infrastructure investment is in the US. We now also spend billions of dollars per year making programming abroad. And instead of just licensing local titles, we are now making local shows and films in many countries, commissioned by our local executives that keep our members happy, and our local slates are improving each year. So Netflix is really growing into a global brand overall. Here is some of their share of TV time in the UK. You can see that they are 9% TV share. So this just goes to show, guys, if you were to pull up a pie chart of I don't have it in front of me right now, probably should have done it, but if you guys do it on your own, if you take a look at the share of watch time just for, either whether it be, versus YouTube or versus linear TV, in most markets, Netflix is sitting between 9 and 11%. And linear TV is still a very big chunk of the market that they can take, not only from other competitors, but just from normal cable TV. So the total addressable market of Netflix is still very, very, very huge, despite what you might think. And the company also said that they might be a $1 trillion. They're targeting a $1 trillion market cap. I don't have the headline in front of me, but here, just type in Netflix trillion and it should come up, right? So, that's the game, rather. Netflix co-chiefs downplay the $1 trillion valuation plan as long-term aspirations. They say it's a very realistic goal, but they want to kind of stay humble, right? But it is very possible that if that were the case, right, the valuation right now is $416 billion. I think they can do it, guys. Like Netflix, even though the share price is high, share price doesn't matter. It's all about market cap. Maybe they'll do a share stock split eventually, which would be good for those of us that want to write options on this stock as well. But going to $1 trillion in the long-term future may not be that far-fetched overall. So that is your earnings recap. Highly profitable company, increasing net margins overall, the best that they've ever had at 27.4%. Debt is not a problem for the company either. You can see only $18 billion of debt, but they do bring in good free cash flow per year and have some cash on the balance sheet overall. overall, in terms of the forecast, you can see right here that it's a very smooth business. EPS is going to hit that exponential curve as they really focus on the more profitable tiers of their subscription model, and revenue just stays up and to the right overall, guys, looking very, very, very good as they expand. So I do still think Netflix has some lift, but it's not going to 2x in 1 year, right? This is a long-term plan for a 2x. Probably the next 3, 4, 5 years is a more adequate time horizon of that. But overall, Netflix has done very well for itself. At the current price, however, of $1,000 in the after hours, you're trading very rich. I will admit you're trading very rich. A 39 forward price to earnings. EPS growth is very good, but eventually that will slow down. And the PEG ratio, because of that high growth, is a 1.7. Netflix is not the cheapest stock in the market right now, not even close. You can even have that seen as by the free cash flow yield being a very low 1.78%. Yes, they're increasing free cash flow every quarter. Yes, their margins are increasing as well, but the valuation right now is very rich. I have this one, full disclaimer, in my long-term portfolio, and I've had it for a very long time, all the way since 2018. I bought the heck out of the 2022 dip at various stages as well. And I keep adding to this one, guys, regularly every single month overall as I continue to DCA into my long-term portfolio that I want to keep for the next 10 years. Fantastic company, valuation a little bit high. If we do not have any positions in Netflix right now, but we want to be a part of it, I don't see anything wrong with buying the company here, but just acknowledge that you are buying it at an expensive level. Trades for me as well, not the best area to trade, guys. I much preferred it down here when it was tagging the 200-day EMA. I mean, you can argue that there's a little bit of a breakout, retest, and run trade here if you want to take that attempt, but it is trading somewhat rich, and you put it on the monthly time frame, yeah, it is quite extended, and even on the 3-month time frame, guys, it's kind of gone, right? So these swing trades, you kind of have to be very careful with them, trade with a stop loss, but for a long-term portfolio, right, it's a nibble for me. If you're starting a long-term portfolio right now, and you want to own Netflix as a part of it, I don't see anything wrong with, starting a position right here, so long as you agree to possibly DCA on any dips that we may have through a somewhat tough economic environment for the remainder of the year. That is everything I had for Netflix overall and everything for our earnings recaps. Hopefully you guys enjoyed those. Now let's get into the TA portion, shall we? So taking a look at the SPY right now, the analysis has not changed at all. This has been largely an inside trading week. Inside what, you ask? Inside last week's trading candle. So we'll start with the weeklies here, guys. Weekly downtrend is very pronounced. We hit the top end of resistance earlier over the course of this last week. And as you can see here, it was a very healthy, almost 70% retracement. And now we are looking to establish some form of higher lows and maybe, just maybe, go for a weekly trend change. Worst case scenario though, well, worst case would be the absolute flush. But there's a third case scenario in which we might just have some form of a tightening range as we move through this earnings season. I'll remind you, earnings is going to be very busy for the next few weeks. This is next week, guys. The next 2 weeks are the busiest 2 weeks of the entire earnings season. We will have very large players next week, such as Tesla, ISRG, Enphase as well, RTX, Lockheed Martin, a few of the defense companies. Then you have Boeing, IBM, ServiceNow, Vertiv, AT&T, Chipotle, American Airlines, Intel, Alphabet on the Thursday session as well. Then the following week, you have all the rest of the big tech companies, Microsoft, Amazon, Apple, stuff like that, Meta as well, right? So it's going to be a very, very big week in terms of earnings, and we'll get a ton of guidance from various sectors in terms of what they think is going to happen with the economy through 2025. So overall, the SPY not really breaking any patterns. We're still in some form of a tightening range. Nice bounce. Higher lows are set with the lows of Thursday. And now, no new daily uptrend just yet, just consolidation. If you break the low of Thursday, that is officially a new daily downtrend. Into support though, 525 down to 495, and you're going to be looking for these bulls to protect these lows and try to set a new weekly uptrend. Or the other best case scenario for the bulls is maintaining a tightening range, but it should be fairly difficult for the bears to get through this area without as much fear as we had back here. We had a tremendous amount of fear back there, guys. Fear and greed was at a 4. It's now at a 21. Your momentum indicators in terms of percentage of stocks above certain levels, I'll remind you, percentage of stocks above their 20-day moving average was a 4, almost a 3. Above their 50-day moving average was a 7, right? You go back historically, like, look, those were historical lows. Big fear. The VIX was at 60, right? And percentage of stocks above their 200-day moving average was at a very low 15%. Also a level that you very rarely see on this chart going back the last 20 plus years overall. So for the SPY to break that area in a short time span over the next week, you're going to have to recreate those fear catalysts. And right now, there's a little bit of game theory at play, right? It seems that everybody has pivoted bearish for the long term. It seems that the entire timeline on Twitter or wherever you look is calling for a recession, right? Everybody thinks things are going to get far worse. Even Jerome Powell yesterday. But here's where the game theory comes in, yeah? If everybody's short, if everybody's hedged, but we know that on the table right now, there is possibly deals, trade deals with over 70 different countries. And the big one, China negotiations, those are all going to be positive catalysts for the market, right? So I truly believe moving forward, there might be a little bit of a twist here. And earnings will obviously throw an extra twist into the markets. But overall, guys, very challenging narrative. I'm not trying to pick sides right here. I'm just saying, right, the tariff news, the damage has largely already been done. So any new tariff news probably is going to hit less and less and less. But any positive negotiations, the market will probably greatly appreciate, as we saw back here, right? So please keep that in mind. There's, the markets are like half math in terms of valuations and everything like that, financial ratios, metrics, institutional positioning, volume, half math. But half is truly as well some game theory and some psychological theory as well. Moving on to the QQQs right now. The Qs, same pattern, right? We had a very nice bounce, a 78% bounce. They set the higher lows right here, the lows of last Thursday, 433, and now we are trying to desperately protect them. If you can protect them and break the highs of this Monday, this will be a confirmed new daily uptrend, however, into resistance, 476 to 465. Break them though, unfortunately, that is a new daily downtrend, and you'll be looking for the bulls to play some defense here, 447 to 430, because if you lose that area, the next big area is all the way down there, guys. 400 to 371. So you have a lot of space right now created. We will see, can they set up the trend change or can they protect some form of a tightening range at the lows right here, which will throw everybody for some curveballs, right? Come to the lows, people go short, they'll clap it back up. If you get into a range, it's going to chop so many people up, guys. So my favorite way of playing these markets, you guys guessed it, selling options well under the market, guaranteeing that if I am assigned, I'm getting the best possible price. And for me on the Qs, that would be the 200-day EMA and the 2021 highs overall. So a bit of a muted week in the Qs as well. Big tech, though, should move the markets next week. Moving on to financials right now. Financials up 0.26%. Same concept, though. Very nice bounce off the lows. You remember me telling you it was a weekly downtrend overall. You did have a very nice sized bounce from the lows, 618 bounce. Now it's up to the bulls. Can they play some defense and go for the trend change, or will we devolve into some form of a tightening range, or will the bears just flush, right? We don't know. That's why we follow the price action. The lows of Thursday are your higher lows. So high, higher low, higher high into resistance, which is 48.31 to 46.75, getting rejected to there now. The next line of defense is down here, 45.78 to about $45 flat. We will see, can the bulls keep it up and go for that weekly trend change, right? Can we do it? Or will the bears take back too much of this move, which increases the likelihood of coming back to the lows or flushing them? My favorite way of playing financials, you guessed it as well, writing short puts well under the markets. Moving on to XLV Healthcare right now, 0.59% to the downside. Very choppy. I mean, you had one name that did wonders today for it, and that name was Eli Lilly, 14% to the upside. However, to the downside, UNH, right? So you had kind of a push and pull. Humana as well got dragged down in that mix as well. So healthcare, very messy chart on healthcare in the past 2 weeks overall. One thing is clear though, who's in control? It is the weekly bears, and the bounce on healthcare was arguably one of the weakest bounces out of all the minor sectors. 0.5, so only a 50% retracement size. It's a coin toss as to whether the bulls can defend these lows and go for a trend change, or will we devolve into a tightening range or just flush the lows? We don't know. And when we don't know, but we know who's in control right here, well, we know that if we're writing options, we have to go a lot lower, right? Now, moving on, this is a very large support area. The 200 EMA is coming close. So if we get some very outsized moves to the downside, could be interesting to write some short puts on the either individual names that are having big declines and not chasing the ones that are up on the day, and maybe just selling some puts in the bottom of the market. As you've noticed, guys, I'm not trying to predict the markets. There's too many things on the table right now. You guys know how this works, right? You You could start off a day nice green, somebody tweets something, you end up red, or Politico writes an article, Routers writes an article about some rumor, and you start off red and you just go green, right? Very volatile markets overall. So rather than predict, we should just react, identify some opportunities, derive some key levels of trade. And for me, that is currently selling some puts under the market. Moving on to SMH right now, down 0.94%. Almost flushing the lows of last Thursday. Same concept on SMH, guys. We've been through this one, for several weeks now at this point in time. You can get a sense of who's in control right here. It is a weekly downtrend, of course. The lower highs are more than likely set almost into resistance. I mean, you can play with this box a little bit, right? But you can tell what we're reacting from. It's roughly 215 up to about 230. And that being said, guys, the size of the bounce on semis was okay. 618 bounce overall, not that bad, but if you lose the last lows of last Thursday, this will officially be a new daily downtrend, and you'll seek for the bulls to really protect these lows, guys. Can they get it done and form some form of a new weekly uptrend into resistance, or will we go into a tightening range, which would throw everybody for a curveball, or will we come more to the downside? My favorite way of playing this, instead of predicting, do I go full YOLO long here? Or do I just bank on the bear's ability to have weekly downtrend follow through more, right? Those are both gamble trades. We're in the middle of support and resistance. So it is somewhat of a gamble, especially with so many moving parts in terms of macro headlines. My preferred way of doing things, very simple. When SMH is down, when some semis are down a lot on the day, I will gladly write short puts under the market. The next big area of support is your 200 weekly, the fear lows 175. And below that, it's a big one, 160 down to 140, which is the 2023 area of consolidation and the 2021 highs. Moving into the Russell at this point, 0.82% to the upside. So the Russell participating in today's rally, but not really breaking any key levels overall. Still trapped between two levels, resistance 188 up to 199. That is a very large level. I will remind you, support from back here, resistance from 2022, and support as well late 2021. Very big level. And keep in mind, who's in control here? Well, obviously the weekly bears are in control, and the Russell having one of the weakest bounces out of all the indexes that we track. Only a 50, arguably at a close, only a 38.2% bounce. So it does favor a rollover by the bears to the lows, but they're protecting the lows of Thursday, right? Just somewhat of a tightening range right now. Inside candles, so the lows are still here, 177.43. You break that to the downside, and the likelihood of retesting the lows or lower is very high. I'll remind you, the support range right now for the Russell is 178 down to 164. Also, a very big key level. I'm not looking to position in the Russell directly. If you guys want to nibble, no problem at all. It is still somewhat weekly oversold conditions. I would be a bigger fan of selling puts under the market. And lastly, the Dow Jones. The Dow Jones getting hit 1.33 because UNH represents a very large portion of the Dow Jones. I'll remind you, the Dow Jones is a price-weighted index, meaning that the companies that have the biggest impact on it, right? Dow Jones 30 is weighted by price, meaning the companies that have the higher share price in the index have the largest weight. So when UNH is your second largest company by price weight, well, obviously when it's down 22%, it's going to impact the Dow Jones by a lot, right? Keeping that in mind, same concept as the rest of the market, guys. Weekly downtrends are in control in the favor of the bears. Nice little bounce, but into resistance, 41.3 down to roughly 40,300 respectively. The size of the bounce was very adequate right now, up about 618, and now we are coming back down into support, 39,000 down to about 38,000. Very tough to call either way. The bears have not broken the Thursday lows. We are into support. The bulls still have a chance at trying to recapture the uptrend or just devolving into some awkward, very awkward range between resistance and support. The worst case scenario, of course, would be the rollover, recapture of the trend, and revisiting the fear lows. I would love to find the Dow back down there again. That would be top to bottom declines of 18% on the Dow into the 200 weekly EMA, which the Dow very rarely tests, but when it does, it has always been synonymous with a phenomenal buying opportunity, and it would also be the 2021 highs and the 2023 highs as well. So I'll keep you posted on those Dow Jones developments. Now, XLP having a very good day for consumer defensives overall, guys. They're kind of looking to do it right now. We have a very large engulfing move, 100% engulfer right now. Higher lows are set, going for the higher highs, going for the trend change overall. A very attractive chart right now. On the weekly time frame, that looks something like this, where they had the weekly downtrend, fully engulfing move on the weekly now might be looking to push the highs as value and defensive names come to front and center. These names don't always do well. Oftentimes, they perform quite poorly for long, extended periods of time. But when they choose to run and in an environment that is uncertain, we may just see a retest of the local highs very soon. If we get a pullback, again, I'll be a big fan of selling some put options down there. Utilities also known to be a very defensive sector overall because of the juicy dividend yields that are associated with them, also with a very nice bounce. Weekly downturn was clear as day, but now you have a very attractive engulfing move overall above the area of resistance, support 77 down to 72, which are the highs of the 22 market overall. Somewhat choppy on the daily, but you can clearly see what the bulls are trying to do. They're trying to go for the expansion beyond the all-time highs. I'm still a fan of writing some short puts on utilities down here. If you want to acquire some shares and have a more defensive barbell approach to the market, utilities is a fair bet overall. Into real estate right now, 1.58% to the upside. It really got crushed when yields were rising because real estate does not like rising yields overall. So keep that in mind. Weekly downturn was clear as day. We have a very nice bounce underway on real estate, starting to reclaim this area that should be, my bad, it should right now be resistance. So I'll change that to a red box as we flush through it. So now this whole area is resistance overall, but a very nice bounce by the bulls underway. That's a 78% bounce. So they'll be looking to probably either engulf this fully or two-stage recovery process for a lot of your real estate names out there. Real estate could be a somewhat, volatile trade, especially in times of an economic downturn. The better protection would be like healthcare, XLP, and XLU. But special shout out to real estate if you're a fan of betting on those decreases in interest rates overall, and you're willing to weather the storm this year to possibly see some very nice upside come 2026. 2027. Moving on to energy. Lastly, energy also reacting from the lows of support 80.70 down to about $74.60. Testing the 200 weekly moving average again. Just keep in mind that we broke a very big level. 84 up to 90 is now resistance for a lot of these companies, right? And even the index alike. Energy, not a bad trade overall. But it's a very complex trade right now. Geopolitical issues, right? Supply, demand, bullish oil seasonality. The way that I like playing this, guys, is when I see oil companies at a low level like this, I like to write short puts under the market on something like a CVX, something like an Exxon Mobil. I like to write on red days when it comes below, but energy is not a crucial component of my portfolio. Bit of a complex trade overall. The VIX today was down 9.1%. So not too bad, but we know off the record, they're not really record highs, but they're short-term highs, right? It's off those highs as volatility has been coming down. To get all the way back up here, you would need to recreate the same levels of fear, and we just do not have that just yet. But don't get it twisted, right? We can see some weird moves on the VIX off of some political headlines, and the VIX can stay elevated for, longer than you might expect, right? It's coming now into back into the 20s, but it can stay between 25 and 35 on some random pops. We saw that all throughout 2022. We saw it after the pandemic where it took a while for the VIX to kind of lean out. And even in the flash crash of 2011, and of course, the great financial crisis, the VIX can stay elevated for longer than you might expect. So as volatility is still front and center on everybody's minds right now, my favorite position to be is not an options buyer, especially in a somewhat directionless market. You could argue that the market has a bearish lean to it, and it does, right? But game theory would state that, the biggest moves can possibly now come to the upside as well. So keep that in mind. So rather than trying to predict short-term directions and position heavily and take a gamble on it, right? Well, I'm just going to be looking to sell puts in the market when a VIX is very high. You would rather prefer to be an options seller. Moving on to the yields right now. So yields as well, very complex trade, guys. It's been back and forth all week. We know that there's problems in the bond market. Structure right now does favor the recapture of the daily uptrend by the yield bulls, aka the bond bears, right? That's the 10. This is the 20. We'll just go into it, right? They've recaptured a key component of structure, the 475 area on the 20-year yields. If we continue to see pressure in the bond market, equities are not going to like that. But if the pressure continues to ease, then maybe we can get a little bit of easing on pressure for equities as well. But something is definitely wrong in the bond market. You could accuse several major global players of dumping US treasuries, whether it be Europe, whether it be Japan, whether it be China. There's something happening in the bond market, a lot of deleveraging happening right now as growth continues to be a concern. And as the US somewhat has lost its predictable nature, at least in the short term. You would expect with heightened probabilities of a recession to people to be flocking to these long-dated US bonds. We just have not seen it yet, which is why TLT still remains very weak. I still think it's a very good trade, but you have to have a very long time horizon. Think 2026 or 2027 when those rate cuts really start working their way into the economy, and maybe we get through a lot of this short-term uncertainty in relation to tariffs and everything geopolitical. And now lastly, gold. Gold continuing to have a very nice run over the course of the week, but pulling back marginally today. No real new big levels of price action on gold overall. Right, on the 4-hour chart, we have now reverted into the 12 EMA on the 4, have not lost it, so just watch for that key loss. The hourly, little bit of an hourly trend loss. Now the bulls are recapturing it into the end of the day. That might be the end of your 4-hour consolidation phase. We might be looking to put one more little push on gold, guys. But, you know, buying it up here is very, very, very extended overall. Extremely extended move on gold. Daily overbought conditions. The weekly is additionally very overbought conditions. And usually when you tap into such overbought conditions, you know, it's not Palantir. It doesn't stay up there forever, right? Eventually, it will need to recover and retrace a little bit, but still, the bulls are in control of every time frame. They control the monthly time frame, which is very extended from the 12 EMA, the weekly, which is also very extended from the 12, and the daily, which is also very extended. I wouldn't be short gold, but I also wouldn't be long. I'd be waiting for more of a pullback into structure to establish some new longs for any swing trades that we might have. That's everything for your sector and somewhat commodity and bond recap. Now let's move into Bitcoin. Bitcoin as well, down about 0.8%. Bitcoin is just doing nothing. Just barcoding right below the 200 weekly EMA. So very tough to determine whether or not the bulls want to continue into a daily uptrend push into resistance structure, which is 92,002. Let's call it 93, down about 87 to keep it easy. Yeah, very, very strong level, both as resistance and prior as support. The weekly bears are still in control of this chart. Weekly downtrend, nice push higher by the bulls right now. You can argue that this is well, not argue, but if you put the fibs on this, it's a 78% retracement. So the bulls do have a chance of either engulfing or putting in a two-step recovery process. But in all likelihood, if the markets don't clear up and the uncertainty is not lifted, maybe you just devolve into some form of a range where you stay stuck between overhead resistance and below support, which is 73 down to 68. I like to accumulate Bitcoin near the lows. And if we're ever swing trading, right, you should be probably liquidating those swing trades, not long-term positions, but swing trades into resistance. Just play it level to level if you can. That is everything on Bitcoin, and altcoins are just doing absolutely nothing because Bitcoin as well is doing absolutely nothing. And that's pretty much everything. Let's now move into our big tech names, shall we? So taking a look at Apple, we're going to do these quickly because not much has changed in terms of structure, right? Apple still in the context of a daily uptrend, looking for a higher low into support. 196 to 187 is that support. Be very careful though. This is your daily higher low, the low of last Thursday overall. You do not want to lose this, and you want to see the bulls, able to push into this resistance range, which currently stands 221 to 210. So you have a contrast of different time frames. As we saw in the indexes, the bears are in control of this weekly downtrend, but with such a very nice bounce overall, right, a 78% bounce, it does offer the bulls a chance to go for a weekly trend change if they want to. That being said, we can also devolve into some awkward range between support and the resistance range as well. My favorite way of playing this stock, as you guys know by now, is selling puts towards the bottom end of the fear lows. Those fear lows are very attractive, guys. Big support from 2023 and 2024, and the highs of the resistance range from 2022. At that point, Apple will be into its 200 weekly EMA, and that support range is 177 to 163. Basically, what I'm saying is, if I can find any strikes down here on a weekly basis, I'm a big fan, but maybe for some positional trades, as we still have too much macro, too much headlines surrounding China, very, very, very tough, guys, to position for some heavy swing trades long, even though it looks that way. But if we wanted to do it from here, backtesting support, the stop goes below there and the take profit goes into the resistance. Moving on to AMD right now. AMD also somewhat down on the week, and like other semiconductors, at the lows of Thursday, yeah? So very nice bounce by AMD overall, as in terms of the size of the bounce. All right, I'll do it on the weekly rather, because it makes more sense. Weekly, big downtrend. The size of the bounce right now on the weekly, somewhat weak, only a 50% retracement candle, and the bears have done a good job of bringing that one back down. If you flush the lows of Thursday, which they put at 85.66, unfortunately, that is A, daily downtrend. No new highs into resistance 112 to 98. And if you get the lower lows, daily downtrend overall, guys. New daily downtrend, and you'll be looking for the bulls to place support in the bottom end of the range, which is currently $83 down to $65, which are the lows of the 2022 bear market and some of the support lows of the 2021 bull market rally. AMD is currently extremely cheap. Valuation right now is under a 20 forward price to earnings, and the PEG ratio is closer to a 0.6, growing EPS and growing revenue in a very healthy fashion. But we know that, as we saw with Taiwan Semiconductor earlier, right? It does not matter. But if you have a long-term thesis, and by long-term, I mean at least the next 2-3 years in terms of EPS expansion for the company and revenue expansion for the company, this would technically be a level to buy at for some long-term shares, but nibbling, right? Because we know it can go lower. And if we're looking to sell puts to just get some premium, you want to go as low as possible into that area of support. Moving into Amazon right now, down about 0.99%. So Amazon continuing to struggle. Although it's one of the best companies in the world, it is not immune to all of the macro uncertainty. Now, unfortunately, Amazon has done something that the other sector peers have not. Well, number one, what's good, we'll get into that in a bit. What's good is that they have a nice weekly move to the upside after that tariff delay. That was a bounce of roughly 618%, which is very good. It gives the bulls a chance at resetting some form of a weekly uptrend. Amazon has earnings in roughly 2 weeks' time. That being said, we're coming into a large area of support, 172 down to 144. I love writing short puts in this area, and you may, because it's the 2021 high range, I know it's a wide range, but I mean, we have to include all those guys, because they stood there for like a year and a half, right? Now, moving on further, in terms of the daily, one problem here is the fact that they gave back the lows of last Thursday. They tried to go for a daily uptrend, rejection into resistance, 191 to 180, and now daily downtrend. So either one of two things is going to happen, guys, with this daily downtrend. Either we're going to continue flushing and revisit the fear lows, or we're going to devolve into some form of an awkward range into support, but unable to break resistance, which is why it's very difficult to position for heavy short-term upside swing trades, and we are so close to resistance. My favorite way of trading Amazon is selling puts below the market. Fantastic company. We'll get to hear from them in 2 short weeks' time in terms of their earnings. Right now at about 172. I mean, it moves so much. I keep redoing this every now and then, but at 172 right now, it's 10% lower than that roughly, which would mean you're sitting about a 27 forward price to earnings at about a 1.35 peg, which is very good. And free cash flow as well is rising. Most free cash flow ever. They're becoming more and more profitable. And I'll remind you, Amazon's doing something they've never done before, focusing on shareholder returns, more free cash flow, more EPS, more net margins. And Amazon's an octopus. They control so many different lines of business, right? Advertising, television, e-commerce, of course, AWS, the largest cloud provider in the world, so many other things, right? A burgeoning pharmaceutical business as well, the robotics business. EPS expansion for the next 4 years is going to be very good. And the revenue expansion by 2029, you might expect $1 trillion in revenue, which is absolutely nuts. Still one of my favorite long-term companies in the market for nibbling here for long-term portfolio. I mean, the price targets for the long-term guys are going to far exceed probably the $300 mark. I know it doesn't seem like that right now, but Amazon has a lot of juice left on the table. So for a long-term investor, great time to be adding some shares at the somewhat cheaper valuation range, but don't get it twisted. It can go lower. And if we're looking to swing trade, well, my favorite version of swing trade right now is selling puts under the market. Moving on to Google. Google as well, down about 1.38% overall. And Google too today, unfortunately, guys, unfortunately, getting hit with another Department of Justice lawsuit allegation. This time, well, not the DOJ, but from Europe as well. Europe has ruled their advertising business to be a monopoly. Now, last fall, we had a ruling by the Department of Justice in the US that their search business was a monopoly. So Google continuously gets hits by all sides right now, which is why their valuation is so cheap. It's reflecting the fact that Google is heading into somewhat of an uncertain time for the company. That being said, the fundamentals are still solid. Great net margins, great cloud revenue growth, tremendous free cash flow growth as well. However, guys, they do have earnings coming up next Thursday, right? So keep that in mind. We're not going to be able to derive much price action for Google before then, because it probably will move 7 to 10% in either direction. That being said, we are below resistance, which is 175 down to about 163, and support, which stands at about 149 to 134. My favorite way of playing this, Well, nibbling for the long-term portfolio, if you believe in Google, is a yes because the valuation is so cheap. But swing trading, guys, I'm a big fan of selling puts under the market right now because now we've kind of have a bit of loss of structure, right? Daily uptrend. Now, unfortunately, we've cut the lows, so the uptrend is now lost. The bears are trying to go for the daily downtrend and recapture of those lows. We'll see if they can get it, but you'll see I took a swing trade on Google today, a short put rather, into the earnings week, which I'm pretty sure will be almost worthless by Monday. But when Google has some big moves off of headlines, you can find some very good premium at some crazy levels. I got a 126 short put off today, guys, for like, 27, 28% annualized ROI, which is fantastic in my opinion. On to Meta right now. Meta down 0.17%. Meta is one of the ones that is almost retesting its fear lows. It has earnings in 2 weeks' time. Meta is battling with a few things right now. Number one, of course, front and center is the possibility of an economic downturn. So that means that people are going to pull back on advertising spend. We also know that Temu has stopped advertising on Meta altogether. Why? Well, because Trump abolished the de minimis, right? I'll show you what that means. Trump abolished there was a rule under which Temu was shipping a bunch of products into the US in tons of different small packages at once to avoid any import duty fees overall. That was called the de minimis exemption. Anything under $800 could be shipped into the United States and avoid a lot of the issues, right? Now, Trump has officially canceled that. He did that about a week ago. So now Temu, unfortunately, might have to pull out, and they pretty much canceled a lot of their advertising on Meta. We'll see if that Temu does a ton of advertising, guys. We will see if that impacts their earnings coming up in 2 weeks' time. Article of news number 2 against Meta, well, of course, is just the risk of them having to divest their Instagram and WhatsApp businesses, as once again, this company is being accused of being a monopoly of social media at this point in time, right? So Facebook facing a few, or Meta rather, excuse me, Meta is facing a few key issues right now, which means that its share price has turned it from a lead bull for a very long time into one of the ones that has the weakest price action from its respective bounce. At this point in time now, guys, the daily downtrend is pretty much set, right, at this point in time. So the weeklies is not looking good. Still a weekly downtrend. Nice bounce, though, into resistance, which was 600 down to 556, but now retesting support, 530 down to roughly 451. I'm a big fan of selling some puts in the market on Meta below where we are right now, of course, into the lows of that support range, and even adding it to the long-term portfolio right now, guys. It's very cheap, right? Trading around a 24 price to earnings, relatively okay PEG ratio, and a very decent free cash flow yield. I mean, I don't think Meta's going to have any problems in the future. It's a very solid company, but it does have several issues that is plaguing it right now. Moving on to Microsoft. Microsoft down 1% over the course of the day as well. And a lot of these tech companies, guys, they closed at the lows of the week overall. And Microsoft too, almost fracturing the lows of last Thursday as they just pretty much went down after tapping into resistance. 408 down to 393. Microsoft has earnings in roughly 2 weeks worth of time. Fantastic company overall, but the price action does not lie. After a very nice bounce, the bounce was as a result of a weekly downtrend. Nice bounce, fully engulfing bounce. The bulls have a chance of trying to set a higher low and going for the trend change. But if they cannot, we might just evolve similarly into some form of a very weird range of accumulation, or the bears retesting the fear lows. At that point, that will be Microsoft in around 346 down to 323, around the 200 weekly EMA and the 2023 chop zone and the all-time highs of 2021. Microsoft, a fantastic company overall. The valuation, I will admit, is a bit high, but that's just because Microsoft is a very consistent company, guys. They usually do not lose net margins in economic downturns, not by that much. And also in terms of their EPS, you can see the bear market 2022, their EPS went up and the revenue as well went up. This company is somewhat immune to tariffs, as a lot of their products are not subject to tariffs to begin with. But what they are not immune to is headline risk in case Europe chooses to go after American big tech in retaliation response. Even though they said they wouldn't be giving any retaliation, it's still like an overhang, right? Around a lot of these tech businesses. Moving on to Netflix. I mean, we already covered Netflix, so I'll go over it very briefly, right? Netflix right now is at $1,000. So $1,000 roughly is not quite clearing the resistance highs overall. I'm a bigger fan of trying to find some Netflix opportunity at the lows, but Very solid chart, guys. We went over the earnings. We're not going to spend much time on it at all, but there is one tiny swing trade opportunity here, which is the infamous breakout retest, right? If you break out of a level, you want to retest it to the downside, could offer some entries. Stop loss would go below there, and then you'd be targeting the all-time highs for the breakout conditions beyond 1060. Moving on to NVIDIA right now, down about 2.87% overall as semiconductors continue to struggle. Nothing happened to NVIDIA today, guys. No news, but it just goes to show semis are just very weak. The lows of Thursday are 99.25. If you were to lose that, the daily downtrend is reestablished. They struggle into resistance 117. It's 115 down to roughly $100. You can move this box around, a couple percentage points up or down if you want to, so long as you understand what's at play here, right? It's a very large area of chop, both as support and now resistance for the bulls. Lower end of support below is 96 down to roughly $76. My favorite way of playing NVIDIA is selling puts under the market right now at $100. The valuation is somewhat attractive, but we know there's a lot of problems that NVIDIA is facing right now. I'm not saying that they won't continue to be a fantastic company into 2026, 2027, 2028, but the revenue is going like this. The EPS is going like this. In other words, they're kind of running out of pricing power overall, as we know that a lot of these systems that are being built for these infrastructure build-outs, I mean, the bulk of it is being built out now. And although NVIDIA will have a refresh cycle, I mean, they've went from the Hopper generation, which was the big build-out, to the Blackwell, which will be a smaller build-out, and then their future ones will be smaller and smaller. Why? Well, because big tech guys are they're not gonna refresh all of the Hoppers to all brand new Blackwells and all brand new future editions of their chips as well, right? They'll probably refresh, I don't know, like 10, 20% of the outdated ones to the new ones and stuff like that. So keep that in mind, right? NVIDIA is a fantastic company, but it does have growth risks beyond 2026 as the flattening out of the revenue growth rate and EPS growth rate catch up with it essentially. You can see that right here. It's getting more flat, right? And even the growth, it's not growing like this anymore. It's flattening out. That is what people are concerned about. Nobody's concerned about NVIDIA being a top tier company and continuing to dominate its respective niches in the future. They're concerned about what is the terminal rate of revenue growth and EPS growth for the company. Moving on to Tesla right now. Tesla has earnings next Tuesday, so we're not going to spend too much time on this one. It's going to be very volatile either way, guys. I mean, the expected move on Tesla, we can take a look at it right now, but the expected move on Tesla for next week should be extremely wide, as it always is. I mean, we're expecting like 9%. I wouldn't be surprised if it's closer to like 10 plus percent by next week. And we're just in a range, right? We know the bears are in full control right now of this weekly downtrend. The bulls have done a good job of protecting the 220 down to 200 range of support, and above us is resistance 300 down about 260, right? So we're basically trapped right now. No clearly defined price action. I think that will be maintained as the case into earnings, right? So rather than me trying to predict where this one's going to go through earnings, I'd rather sell puts well below the markets. And I showed you guys that even for earnings, you can get some crazy short puts down here, guys, that pay decent ROI in like the 150s. So those are the ones I'll probably be going for rather than trying to make a sizable swing trade in either direction, long or short, right? Moving on to Palantir right now. Palantir up 1.15%, but this week has basically been a week of almost nothing after the gap up from Monday. We pushed a bit higher, we pushed a bit lower, and we ended kind of somewhere in the middle. The price action structure, though, is pretty good right now. Palantir trying to find a new higher low. The higher lows right now currently stand at $85. If we lose a bit more, at least we have big support, 84 down to 77. In terms of the weekly structure as well, you can see it was a clear weekly downtrend. Nice engulfing move. So if the bulls choose to retest this area, it'll be looking for a weekly higher low and maybe go for some expansion for a little bit of an earnings rally. Earnings are going to be the week of the 5th of May, so still a couple of weeks away. If I do find Palantir down here, maybe I choose to write some short puts in that lower region. But Palantir is still somewhat expensive as a company. It's a show me company, right? Can they show us that they deserve this valuation? I do think so, but it may take a while for the fundamentals to catch up with the share price right now. On to SOFI. SOFI up about 3% today. Very decent day for SOFI, but no clear breaks of price action. Struggling with the $11 resistance range overall. So that being said, the higher lows are set at the lows of last Thursday, looking for the daily trend change break. It's just sideways right now. If you do get that break above 1161, it'll be an official new daily uptrend formation by the bulls and can possibly recapture some more of this weekly damage. As we know, the weekly bears are in full control of this chart right now. The bounce size as of late has been very good. It's a, roughly a 618 bounce. So it gives the bulls a very good chance of either pushing more, or if they fail from here, of maybe resetting a weekly uptrend, or maybe just protecting the lows with some sort of an awkward trading range at the bottom end of price action, which would come into the resistance highs, which are currently about 10, all the way down to roughly $8. Let's call it the top of these guys. SOFI valuation right now in the mid 10s is pretty good at a 0.76 peg. It has a high forward price to earnings, but don't forget, they're growing EPS in a fantastic fashion, improving profitability, and continuously increasing their customer count. Price to sales is very manageable as well. So I like accumulating SOFI shares at the lower end of this range if I can. Moving on to Uber now. Before last, Uber up 3% on the day. Not too bad of a day for them. Weekly was a downtrend. Very nice engulfing move overall. As we can see, the bulls, this is a very nice, clear daily uptrend in motion right now. The higher lows are set at 68.41. If we get a pullback, looking for a higher low, nice to see they have reclaimed support 73.25 to about $69. And this is almost a fully weekly engulfing move. So if the bulls need a break, at least they can come back and retest as support, possibly go for a bit more. If we're already in some swing trades, the take profit zone is, relatively the all-time high area of struggle, which is about 80 down to $77. We're coming into it very shortly as well. Uber valuation right now at 75 has like a 30 forward price to earnings and about a 1.1 peg, which is pretty good all things considered. They're growing EPS very quickly, have a very decent free cash flow yield as well, and very healthy record net profit margins. And now lastly, TSM, we covered this one already, but just a quick recap of the price action. Weekly, the bounce on the weekly was not as significant as we saw for some other names, only a 50% bounce, which means that the bulls, if they cannot mount above 171 to 155, if we do move a bit lower, they have a chance of resetting a higher low into a higher high. Support stays put 147 to 138. I'm a big fan of playing short puts below the market on this one because we already know, we covered it earlier, the valuation is very cheap. So I want to be accumulating some TSM shares for a long-term portfolio if I like the company, but swing trades, I'm going to play it with short puts below the market. It saves me from trying to predict whether or not we get a massive move to the upside or a massive move to the downside. I will just play the VIX, the volatility, by selling put options on this fantastic company. That's pretty much it for your market rundown, guys. No other stocks today. Tomorrow on Good Friday, I might just film a video like a top 5 or a top 10 stocks that I'm looking for, either swing trades or long-term investments in this type of market. On Sunday, I'll be going to the top 5 options list, bringing you guys a ton of bonus plays. So that's when you'll really start to hear me talk about more. But when I go through my portfolio in a few short minutes, you'll understand some of the swing trades I'm going for. And that's kind of the purpose, right? Maybe I don't show that many other stocks on a day-to-day basis, but you guys should get a good impression of the trades that I'm looking for when I show my portfolio several times a week or in the top 5 options videos. Now, speaking of portfolios, let's check out the trades that I have for the remainder of the week, shall we? Or into next week. So before we get into these positions that I have, I figure I should show you some of the ones that were closed today as they are no longer featured here. Some of the ones we closed today were some, expired worthless Micron 63s. We got those earlier yesterday. Elf Beauty is as well. We got those earlier in the week. They expired worthless. And the Rocket Mortgage expired completely worthless today. We closed the Amazons and the Googles early this morning before the markets kind of unraveled. Got some decent profits on those. Those were taken midway through the week as well. I think I showed them to you, but I'm not sure on the Tuesday session. And an SOXL $9 put, which also I closed today at 2 pennies. Those are some of the ones that I closed today. There's a ton of trades that I didn't show you guys yesterday that we kind of closed, and I opened new trades overall. Just understand I'm flipping a lot of these wheel trades on a day-to-day basis, right? Now, the ones I opened today as of new are, well, you can see them in the portfolio because now we're pretty much done with the closed trades. But the ones I have in the portfolio that are new in terms of the wheel trades, only the wheel trades, then we'll cover the rest. So the wheel trades, Elf Beauty, I have those are the ones expiring today. Look at the blue dot ones. Those are the new ones, yeah? Google 126 puts for next week into earnings. Got them for 36 cents after the negative headlines hit Google today. Those are already now slightly profitable, 32% profitable. I have 3 days of free time decay over the weekend, and 126 is crazy low for Google. That will be 18% below. 3 standard deviations. So I'll benefit from that weekly time decay. Micron replaced today's with next week's April 25th. $60 puts for 34 cents, about 0.5%. That's about 12, 13% down on Micron in a single week. I'm just looking to pocket some of the over the weekend time decay. If these are 50% profitable by Monday, I will probably close them and seek another play if I can find one. And then as well, we have a new Rocket Mortgage. Went a little bit aggressive with this one as I do want the shares. Rocket Mortgage, one of the nice swing trades that I want. It's a proxy for yields overall. They've been doing a good job of consolidating their business model with the Redfin acquisition, with the acquisition of Mr. Cooper Mortgage Group as well, which is a very solid mortgage company. I like what Rocket is doing in terms of building right now. Now, 11.7 is the top end of the range, but I would be willing to build this position into the 10s. We'll see if I get assigned or not. I did go aggressive on that one, but it's a very small contract overall. And lastly, an SOXL, which I'm also playing very aggressively because I want the shares, right? So if I want the shares, I'm going very aggressive. 61 cents I got minus commission for this $9 put for next week. I really want some SOXL shares. I think semis right now are just destroyed, and we're probably coming into the bottom end of destruction expectations for that industry. We are now weekly oversold, so I want some shares, guys. If I can build a little SOXL position here, 9 to about, let's call it $6, I will accumulate a couple hundred shares of XOSL and then just hold them. So even though it is a wheel trade, I would not mind turning it into a swing trade for any positive bounces that the sector may have with any of these trade deals, especially with China, that might get negotiated on the table. Now, into the other positions, you'll see that I have a bunch of call debit spreads, some long positions, because I feel that right now, any positive trade deal news can have a nice rally into the markets or any positive earnings as well. So I'm taking a chance here by building a few key long positions, none of which are extremely large, but just building some long-based swing trades to the upside. We have the apples that you guys already know about, the 200 versus the 205. Bull call debit spreads, those are up nicely, but all of the other call debit spreads are down. The Amazon Leap option that I got December 2027, that is down 14% right now. It's fine. I'll hold this one for the next 3 years almost, guys, as well. We have some positions that we're maintaining, such as HIMS and Hood into next week, which are also doing well. Those are wheel trades that were older from just a few days ago, yesterday, as a matter of fact. KWeb, Meta, and Micron. Also some bull call debit spreads. KWeb and Meta, short term, which are currently down right now. No problem. I'll hold this one through earnings. I'll hold this one for a China deal. Look at the time on these. Meta is for June. It's an earnings play and thereafter rally. And August as well is very long time for that China play. Micron as well. 80 versus the 170 bull call debit spread for December of 2027. We're slightly down on that one, but I will hold this one for the next 2.5 years. Nike, same concept, looking for a trend reversal on Nike and just coming back into 60 by July. We'll see if that happens. NVO, I opened this one 2 days ago, and unfortunately, it just went down ever since. I made a play on it. It went down. I have all the way until August to recover these. So unfortunately, that was another play that I just got hit today, 7% with the Eli Lilly news, completely normal. QQQ, this is a bear put debit spread. So I'm playing some downside as a hedge. I opened this one yesterday into resistance, right? Into resistance. That one is just a very small hedge, 2 contracts, up 31% right now. Other than that, you can see I have the TLT still in place. TQQQ, this is a bull call debit spread that I opened after the tariff announcement date all the way into June as well. So we'll see which one hits, guys. Either the QQQ bear temporarily, then maybe I can just keep the June bull call debit spread overall. And then of course we have UNH that I opened today. It's currently down. I didn't get the low of the day. I got it when UNH was down 20. It went down 3% more. I'm fine with that. 490 to 500 bull call debit spread for August. We paid $4.11. It's currently down 13%. And lastly, UPS, which I also opened just last week, after the tariff delay, which is just a logistics play. That one as well is down. So all of these call debit spreads, they're very small, but they're very calculated as well, right? I'm keeping all my long side bets very small. And in the interim, how am I paying for all of these? I've collected an absolute ton of premium in the last 2 weeks, guys, which is why the portfolio hasn't really moved. The long side plays have been bleeding a little bit because it's very tough to time the bottoms of these very volatile ranges of accumulation. But also, we've been collecting a ton of premium. No wheel losses in the last 2 weeks throughout the bear strategy. So that's pretty much everything for the portfolio recap, guys. Hopefully you're able to learn something from how I'm using my put wheel premiums on the wheel. Now I'm done. accumulating longs, right? I have the longs that I wanted. I was patient on them. Now I'll let them ride. And now we're just going to move forward with just continuously wheeling, just using the wheel strategy, guys, collecting anywhere between like $500 to $1,000 per week on any given week, and just building up the net equity like that. Now that I've kind of shopped for all my longs, now we're set. Now we just keep running the wheel strategy overall. So hopefully you guys appreciated today's video. I know it was a long one, but the end of week recaps usually are, especially when we have earnings. If you enjoyed it, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing to the channel as well if you're new. We do these every Monday to Friday after the close. And lastly, if you have any questions on anything, please feel free to leave them down below. I always love reading and answering your guys' comments. And lastly, if you guys want access to all of the trades that I'm making on a day-to-day basis at this time, the longer duration swing trades, either with shares or call debit spreads, the wheel trades, which are very, very ample right now, like 10, 15 trades on any given week, most of which are all profitable because of how I choose them, right? If you're looking for access to all those trades and my long-term portfolio buys as well, the link to the Discord is down in the video description. You can join over 150, almost 200 other members that we all run the same trading strategies. Especially interesting if you are, trying to build a portfolio, whether it's small, medium, or large, and you don't want to take home run trades. You want consistent trades and consistent long-term portfolio building. It might just be a community that you could enjoy. We also do private morning live streams every Monday to Friday, where I stream live for 2 to 3 hours, where I trade live and answer all your questions on your stocks, your options, the long-term portfolios as well. If you can't be there, they're all recorded so you can watch them later. And you have access to all our chat rooms in which I answer any and all questions all throughout the day. Very fast to answer everybody's questions overall. And we also have private videos, guys, in which I showcase different strategies that I don't show so much on YouTube in terms of debit strategies, credit strategies, how to grow portfolios from small, medium to large, what allocation of a trading portfolio should be kept in which strategy depending on the size, and many different videos like that, right? Like fundamental, trading videos overall. And you also get access to all my charts as well, guys. Whenever you see some technical analysis like this, all my watch lists, all my charts, and whenever I do annotations for earnings as well on over 100+ different companies, you just get to copy paste everything with 2 very easy clicks of a button. You get all my trading view charts. That's everything for today's video, guys. Have a very nice long weekend. Enjoy it. Get some rest, relax a little bit, and come back to the markets Monday morning locked in, and we will do it all again. So take care. That's it for me. See you guys soon, and peace.